Hello and welcome to a special video by Financial Earning. On today's video, we're going to break down Mullen's latest 10Q. We're going to go over their earnings, their financials, as well as share count. We're going to talk a little bit about some different lawsuits, settlements, different amounts of debt. We're going to go over quite a bit, so go ahead and stay tuned. But before we do that, I just want to remind everybody that this is not financial advice. This is for entertainment purposes only. Hopefully you guys all enjoy it, and let's go ahead and get started. All right, first we're going to go ahead and look at the left side of the screen here. We're going to go over Mullen's asset column. So looking at cash and cash equivalents, you can see going from September 30 to December 31st, there was a reduction in cash from 155.2 million to 81.5 million. Restricted cash went up. It went from 429,000 to 7,426,000. We'll go into a little bit more details on the restricted cash on another slide. And then inventory went from 16.8 million to 30.7 million. Again, we're going to go over the inventory in a little bit more detail on a future slide. The next thing I want to point out is under the total current assets, which would include property, plant, equipment. I highlighted equipment because, as you can see, the number changed from 82 million to 86.9 million. I believe that was part of the Romeo Power asset acquisition. And then you're going to see right of use assets. And you may be asking yourself, what is right of use assets? And that's actually the assets that are used in the form of any type of lease. So if you're leasing equipment, different things that are considered an asset, you can actually put that into your asset column, and then it has various amounts of depreciation and things of that nature that can be used. Going down into the liability column, I went ahead and just highlighted some of the heaviest hitters as far as changes go. You can see derivative liabilities from September ending was 64.8 million. December ending was at 20.7 million. So less liabilities in terms of derivatives. So that's good progress for Mullen. My hope is that there's no new security purchase agreements for the January through March quarter, and in that case, that section should actually be zeroed out, which would be excellent. Going down under lease liabilities, net of current portion, you can see that the lease liabilities went from 3.5 million to 9.2 million. So again, we do know that there were some additional leasing activities going on this last quarter. Looking at the top right of this screen, you're going to see common stock. As of December 31st, it was at 5.884 million. And that was the amount issued and outstanding. Stockholder equity remained flat at 271.8 million in December versus 272.8 million. And as of February 9th, 2024, I did want to mention this. You can see that the outstanding share count for common shares has increased to 6.552 million compared to that 5.884 million. So there's been a little bit of discussions on this already. What I did want to point out in the last proxy information, we did see that Equitas Group Holdings still had a total of 870,743 shares of common stock, which could be issuable upon exercise of their warrants. And that calculation was as of January 12th, 2024. So we know that as the share price changes, the quantity of shares that would be exercised is actually going to change as well. So I just want to point that out. We haven't received any new information and a new 8K in terms of any warrants being exercised. But in my opinion, after just looking over these numbers, it does appear that Equitas must have been exercising some additional warrants. All right, on this slide, we're going to go to the left. You're going to look at the operating expenses. We're going to break down the general administrative and then the R&D. So general administrative, actually looking at the December 2022, was sitting at 64.996 million. Whereas December 2023, it was only at 43.234 million. And we'll talk a little bit about what changed in the general administrative side of things. And then looking at research and development, we do see an uptick there. Went from 8.622 million in December 2022 to 16.169 million for December 2023. We do know that there was quite a bit of activities this past quarter in terms of homologation, in terms of some of the Mullen 5 RS, and some of the other development and researching initiatives, including some of the battery testing and things of that nature. So going into some more expenses, looking at the other income expenses, I want to first point out derivative liability. So these are the expenses in terms of the exercising of shares. So you can see in December 2022, there was a total expense for liabilities of $255.960 million compared to nothing this past 3 months of December of 2023. So there's been no new security purchase agreements, just as Mullen Automotive has been mentioning to us shareholders. The next section I want to talk about is the loss of derivative liability revaluation. That shrunk. It was $40.781 million back in December 2022. Now it is only $6.728 million in December 2023. A couple of other things, not very large items, but just wanted to point it out. Looks like there was a sale of some of their fixed assets, accounting for $75,990. And then there was a lease termination for $50,000. So those would actually be reduction of those expense lines. And then interest expense. You can see that there was quite a bit of debt back in December 2022, and the interest back then was $2.828 million, whereas as of December 2023, the 3-month ending, it was only $258,023. One more thing I want to show is just the net loss attributable to stockholders. So you can see for the 3 months ending December 31st, 2022, it was at $376 million, whereas December 2023, it was at $61 million. So definitely an improvement in terms of net loss to stockholders. So Mullen is going in the right direction, in my opinion. Going down into net loss per share, this actually complements what I just said. You can see December 2022 ending was at $6,233 net loss per share, whereas this past December 2023, Mullen was only at $15.32 net loss per share. Going to the right-hand side, breaking down cash flow a little bit more, you can look at that net loss column again. We kind of already went over that a little bit. That's at $378 million in December 2022 versus $63.9 million in December 2023. I want to talk about stock-based compensation. So we can see this is actually a very large difference between December 2022 and December 2023. That actually goes into the general administrative bucket in terms of operation expenses. So I did want to point that out. So you can see there that for December 2023, it was only $13.9 million. And then it goes into a little bit more about those derivative liabilities that we already talked about a little bit on the left. The initial recognition of derivative liabilities there as well. And then another section, it's a little bit different. It's a gain on conversion of derivative liabilities to common stock. So there was no hits at all in December 2023 for either of those two categories I just mentioned. No hits as well on loss of over-exercise of warrants. As you know, there was some notations in previous filings about one of the lenders having some complaints over exercising warrants, and Mullen actually had to pay them some additional money in terms of shares to compensate for that. And then if you look at loss on extinguishment of debt, there was no loss in December 2023. Going into inventories, again, for the 3 months ending December 31st, it's at $13.9 million. Prepaid other assets actually went down. So from a cash flow standpoint, there was less going out in prepaids. And then net cash used on operating activities, that actually increased. So December 2022 3-month ending was $33.227 million, whereas December 2023, it was at $59.891 million. Cash flows from investing activities. You can see a purchase of equipment. It was only $726,000 back in 2022, whereas December 2023 is now at $6.865 million. So again, I did mention this a little bit. This has to do with some of the equipment that was purchased in form of asset for Romeo Power, as well as some additional heavy equipment and machinery that we did see at that Fullerton location. So Mullen has been purchasing additional manufacturing equipment for the battery packs, and I'm sure other smaller expenses that will be adding up in terms of getting the assembly line there in the Tunica facility up and running for both the Class 3 and the Class 1s. You can see the Elms asset purchase. Obviously, there's nothing there in terms of cash flows for December 2023. You can see it was a big chunk of December 2022. Let's see, and as far as cash flows from financing activities, again, Mullen has stated there's been no security purchase agreements. And you can actually see that there's a $0 line in terms of any kind of net cash from financing activities. So back in December 2022, Mullen did receive $150 million from lenders, and they had to exchange that in terms of warrants. So going down a little bit further, we're going to look into the change in cash. So we can see that Mullen actually spent $66.757 million in December 2023 for those 3 quarters. And then cash restricted cash, there is that listed there at $7.426 million. Again, we'll go over exactly what that breaks down between those 2 line items in a future slide. But you can see, including the cash restricted cash, it's at 88.939 million for December 2023. All right, as I mentioned, in terms of restricted cash, if you look at the top left, you're going to see the main part of restricted cash was the $7 million escrow that had to be put into an account for the GEM group arbitration activities, and then there's another $429,000 that had already been in restricted cash, and it's still there to date, and that has to do with customer deposits. And then I want to talk a little bit about revenue recognition. So I kind of highlighted a couple of the points there. Company applies a 5-step analysis. So step 1, identify the contract with the customer. Step 2, identify the performance obligations in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to performance obligations. And then step 5, recognize revenue when or as the company satisfies performance obligation. Next thing I wanted to point out is revenue from sale of electric vehicles is recognized when the control of the vehicle is transferred to the customer. But that is in general. So the control is typically transferred at point of delivery. However, certain contracts with Mullen, specifically the Randy Marion Auto contract, contains certain provisions that they can return unsold vehicles after 1 year. So because of the verbiage and the clause in those types of contracts, Mullen has deferred revenue recognition until the vehicles have been officially sold by the dealer to the final customer. There is a section, a clause, they talk a little bit about a refund liability recognition. I don't really see that at all in the rest of the 10Q. If anyone did, please drop a comment. Let me know exactly where I need to be looking in terms of that. But I just want to kind of show that. So that is a way that Mullen is able to kind of show some revenue in terms of a refund liability. It's not going to be the same as being put into the revenue column, but it's something to talk about. And then we'll look a little bit into the inventories, and you can kind of see some of these vehicles that have actually been delivered to the dealer. However, they haven't been sold. A little bit. You have inventory. If you look at the top left, we're going to break that down a little bit. So if you look at total inventory, you can see December 31st, 2023 sitting at 30.719 million compared to September 2023 of only 16.807 million. So almost double the inventory kind of increase there over the 3 months. Just let's break that down a little bit further. So work in process, you can see is about $1 million added, or an increase for these 3 months. Raw materials had about a $5 million increase, and then finished goods delivered to dealer for distribution. So these would be the vehicles that are actually sitting at RMA's lots that haven't officially been sold, so they're not recognized as revenue, but they are recognized as part of the inventory number. So that's almost $8 million worth of inventory there. So what's interesting and what I like about this breakdown is we can kind of get a better understanding of how much material is currently sitting at Mullen Automotive's production facility there, or assembly facility there in Tunica. And between the work in process, which means the frames are actually on the assembly lines, they're getting different either battery packs installed on them or different wirings, different lights are getting installed. That's that 4 million. And then raw materials. So these would be the frames or the chassis and cab, if you will, and maybe some battery packs, different things that have came from or imported in from overseas, but they haven't actually started the assembly process yet. So this is actually showing that potentially Mullen has about $30.7 million that they could be recognizing in terms of revenue. And another thing I did want to point out, though, is this is not including any type of profit that they would be charging to Randy Marion, which would actually increase this. So, you can speculate that they could receive about 20% profit. So you could look at increasing the total inventory to figure out revenue by about 20% more. So that puts it at about $36 million there in potential revenue. Looking down at the bottom left, kind of talk a little bit about Mullen's debt. One really good tidbit of information that I was able to kind of put together. So as of December 31st, 2023, there was a total debt of $7.6 million. However, the company actually ended up repaying by the end of January $5 million of that debt. So that real estate note is completely paid for, which is actually really good news, which means they own the facility scot-free. Then the remaining debt total is only $2.7 million. So a company that has two fully capable facilities as well as some significant assets there only has $2.7 million in debt. So and that would be kind of like liability debt. So pretty excited about that. In my opinion, they've done a great job of utilizing their cash to kind of reduce that debt, so they're not wasting money on a lot of interest. Let's talk a little bit about that promissory note. Everyone noticed that 8K that came out in December, specifically December 18th. It was a $50 million promissory note, which provided Mullen with $32 million of capital to be able to use towards operating expenses. So that left a $18 million discount. So a lot of people are scratching their heads wondering, why would Mullen sign up for an $18 million discounted loan? It seemed like it was very toxic at the time. Mullen finally came out now and published it in this 10Q, exactly what the breakdown is for that. So let's go ahead and read this middle section here. It says that the $18 million original issue discount was considered a settlement cost related to a dispute over financings that occurred during the fiscal year end September 30th, 2023. So the $18 million has been accrued as of September 30th, 2023, and it's included in the accrued expenses and other liabilities in the December 31st, 2023 and December 30th, 2023. So when the debt is issued, the $18 million will be reclassified to note payable. And again, I just want to show that this note incurs a 10% annual interest, which escalates to 18% on default, and it matures 3 months post issuance. So a lot of information I just kind of unpacked there. Glad to see that we got a little bit more information in terms of this. One other thing that we will see in a future slide is the fact that as of February 12th, this still has not actually been exercised. So that 3-month window for paying interest and that default hasn't even begun to date. Through that section and talk a little bit about those dreaded warrants. So if you read through that section, you're going to see preferred D warrants with a fair value of $20,704,136 still remained outstanding as of December 31st, 2023. So we know that Aquitas actually still was holding on to close to 70,000 warrants, which could be exercisable for up to 800, I think it was 870,000 shares, and that was based off of the proxy material that Mullen provided us. As of December 31st, though, you can see that those warrants have a fair value of at $20.7 million. Looking a little bit more on the balance sheet there, as of December 31st, 2023, the remaining warrants in terms of common shares conversion was sitting at $20.7 million. talking a lot of stock-based compensation. So a lot of people have been talking a lot about this. One thing I did want to point out, looking at the 3 months ending December of 2023, total share-based compensation was only 13.9 million, and this includes everyone from directors, officers, employees, consultants, and then also some liability classified consultants. So just a various amount. This 13.9 was not going all to the CEO, as some may like to say. You can actually see the breakdown here, and it's actually a lot less on share-based compensation compared to the previous year, ending December 30th of 2022, or December 31st. Looking at the largest delta there, you're going to see a compensation to employees actually is reduced significantly. And what that reduction is mostly in terms of was that share-based compensation. So it was a big drop between those two years for the 3 months. Complaint, stuck it around. We have one more slide after this one, but I know everyone's been interested into what types of lawsuit information was going to be getting shared on the 10Q, so I went ahead and broke that down here. So let's start at the top left. The first section there is more about the initial DBI and drawbridge investment complaint with Mullen. If you want to, you can pause and kind of read that. I'm going to go down to the highlighted section, which is mostly relative for this quarter. So on December 5th, 2023, as part of a settlement, Drawbridge withdrew its appeal to Mullen's motion to dismiss, which was granted by the court on August 25th. With prejudice, which means they cannot go back and change their mind on this. So this specific, $100 million money damages and the due to the $25 million worth of Series E stocks, all that stuff is being nullified, and the settlement actually finished up December 31st. The company basically is accruing $1.95 million to complete the satisfaction of the claim. So in my mind, this is actually a very good settlement for Mullen. If you look at what Drawbridge was going after Mullen for, Mullen was successful in to settle this outside of trial or anything like that, and yeah, everything's been dismissed with prejudice. The second one I want to talk about is the GEM claim. This has to do with the arbitration demand. So we know that Mullen had to put $7 million into an interest-bearing account and became restricted cash. On January 24th, 2024, arbitrator actually ordered Mullen to deposit $24.114 million into an escrow account before March 9th of 2024. So Mullen immediately filed an action in the United States District Court, Central District of California, contesting the arbitrator's decision, as well as filed an action in the United States District Court for the Southern District of New York, seeking to void GEM's group agreement made that it violates Securities Act, because GEM Group is not a registered FINRA dealer. So this is one of the lawsuits that we are made aware of, that Mark Basil and his team are currently reviewing and seeking to basically nullify this entire GEM claim and get that arbitration money back in Mullen's asset column as free cash. Looking down at the bottom left, this has to do with Mullen Technologies Incorporated. So this is all done as of January 16th, 2024. Mullen Automotive actually received a cash payment in full settlement of $2.7 million. So MTI has paid Mullen for that transition service. So now there is no longer any type of ties financially with MTI. Going to the top right, I already talked a little bit about the promissory note. I did highlight it again. If you want to pause it and read through it all, you can. We already talked about the $32 million that Mullen will be receiving for operating expenses. They have the $18 million discount that has to do with the settlement due to some of the security purchase disputes with Isusa. But you can see that as of February 12th, 2024, the loan has not been received. And as I mentioned before, the interest and the actual loan itself, the default term, which is 3 months, doesn't start until the actual loan has been received and executed. So we'll have to see exactly when Mullen decides to go ahead and transact this loan. They will need to be doing some form of transaction on this because of the settlement. This is basically part of that $18 million they're going to have to pay. Point out that on the 10Q, Mullen did not include any of the deliveries that were originally on the 8K today for delivering to Rainy Marion Auto. I went ahead and highlighted the invoice amount that has not been received as cash yet. So you can see from the September 30th quarter, there's from the class 3 trucks, the 10 trucks, there's $652,000 that has been invoiced but no cash. I'm sorry, no revenue recognized. And then looking at the Mullen class 3 trucks for the December 31st quarter end and the class 1 vans, the 100 vans, overall for invoiced amount is 11.9 million. And again, no cash has been received as of December 31st and no revenue recognized. So there's going to be a significant amount of revenue coming up in the next quarter. In my opinion, it should pose Mullen to see at least $30 million. So I'm pretty excited for this next quarter. I feel like this 10Q had some good information. It does appear to show that additional warrants were exercised. This was not dilution, Dave, as some of these bears like to say. This has to do with the warrants that we already know about. Those are getting exercised. So the share count is still sitting under the options trading amount of 7 million. And as you can see here, there's quite a bit of revenue that is going to be getting rolled into the next quarter. And as you may also be aware, I have had conversations with Brad from Rainy Marion Auto, and they're currently working on getting those financing agreements set up to be able to have their end users or end customers go ahead and take out loans to pay for some of these vehicles. And they're also working on an allied floor plan that's going to help them provide Mullen with cash within 30 days of getting these vehicles delivered. So if you like this in-depth detail breakdown of the 10Q, please consider again liking and subscribing to this video. If you have any other comments, if you think I missed anything that has significant importance, you want me to make another video about the information, please drop a comment and let me know. And with that said, hope you have a great rest of the week.